This is what Tom Lee just said about Nvidia and our markets.
This week. So can the momentum continue? Let's ask Tom Lee. He's FundStrat's managing partner and head of research. And as you see, he joins me now. Tom, it's good to see you. Welcome back.
Good to see you, Scott.
That was the news of the day this morning. We're buyers of stocks on Friday, but even stronger if the jobs report is soft. The implication being you're buying no matter what. So it wasn't soft. It was hotter than expected. But nonetheless, why did you come into today thinking you were buying stocks regardless?
Well, there's a couple reasons, Scott. The first is that I think markets are much more focused on inflation reports and CPIs next week and the June FOMC meeting on Wednesday. And the second, which of course we think is going to just show a continued improvement in inflation. But the second is that stocks really historically have done well in the week following the release of the employment report, rising roughly 70% of the time. And it implies roughly 70 to 80 points in the S&P. Of course, it would be better if it was a soft jobs report, and it wasn't.
Well, it's funny you say that. It would be better if it was a soft jobs report, because I think the market spent a good amount of today deciding, what it was. Was it good news is good news is bad news? I mean, if the market doesn't necessarily need rate cuts, why is a softer report better? Why can't we just be happy with good news? Labor market's strong, economy's hanging in, don't need rate cuts, and still may get them later this year.
I generally agree with you, Scott, but as you know, there's a faction of both market participants and the FOMC that view some of this data as too hot for them to be comfortable with. And I think, the more positive data points you get, the more you might actually start to see markets price in a hike. And so I think you're right. There is a Goldilocks window, but it's safer to say bad news is good news because those actually clearly take away inflationary pressures.
I'm wondering if you think in any way that, thinking that June is going to be the point of the year in which we start to get this money off the sidelines and into the market, and how Goldman Sachs framed it the other day, talking about a, quote, wall of money coming in, but not really until July, that you could have some selling between now and then, but that the beginning of the third quarter and thus the second half of the year is the area to really plan for a wall of money coming into this market and then pushing stocks that next leg higher.
Scott, that dynamic is certainly at play for a couple of reasons. One, April was a down month, and I think a lot of institutional investors actually sat out May thinking April was the start of a bigger correction, so June is when money starts coming back in. But I think more importantly, since the end of 2022, I think a lot of institutions and a lot of high net worth individuals sort of sat out this market saying, hey, I'm happy earning 5%. By the middle of this year, if the S&P is up 15%, on top of missing 30% last year, I think a lot of folks are going to say, listen, I can't just sit on cash and earn 5% anymore when I'm missing out potentially on a 25% year for the S&P.
Tom, what'd you make of the fact a couple times this week we had rates go down and stocks go down? Not exactly the dynamic that many had been expecting, right? Because that's not the way that stocks and rates have been reacting, right? They've been pretty well correlated. Rates down, stocks up. Well, there were a couple of occasions this week where that didn't work. Why?
It's kind of hard to tell, especially day to day, but if I had to guess, we don't want to be in a situation where the economy is slowing so much that we've actually hit stall speed, so rates would go down. That type of economic dynamic would scare stocks. So it's almost like bad news is too much bad news. In fact, maybe that's why today's jobs report kind of fits right in the middle, because it's actually good enough to tell us the economy is still strong, as you said, but it's not enough to actually add to inflationary pressures.
Tom, what if this market is just screaming out it's Nvidia's world and we're just living in it? Right? I mean, if Nvidia's up, markets are good. Nvidia's not doing much. S&P can't do that much. Nasdaq's negative today. It's a one-stock story.
Nvidia is really a generational story for now because, how many $3 trillion companies actually have doubled? So clearly Nvidia is important, but it's important because it's really one of the most important ways to get exposure to AI. And I think the AI story is, early innings, as many people talk about. It's transformational in terms of productivity, and there's a lot of use cases developing. So as much as it might feel like a one stock market, as you know, there's a lot of stocks up more than 20% year to date. And I actually think breadth is likely to increase. So for investors, there's a lot of opportunities in the second half.
Non-farm payrolls came in at 272,000 job ads for the month of May. The expected number was 185,000 job ads. This was a number that nobody saw coming. At the same time, the unemployment rate went from 3.9% to an over 2-year high of 4%. But at the same time, in the month of May, full-time employment fell 625,000 jobs, the largest drop since last December. And part-time employment was up 286,000 jobs. So really, how strong is this report? Well, I think we could all argue for it was good, it was not so good. I don't think it makes a lot of sense, and I think Wall Street is quite confused following this data today. 10-year Treasury yields are dropping almost 10-year Treasury yields are up almost 15 basis points today. So Wall Street is saying this is too hot of a report. JP Morgan has officially changed their first Fed rate cut view to November from July. So they just skipped over September and went straight to November, when for the last month or two now, they have been expecting the first cut in July. But this does not necessarily mean that stocks have to fall, okay? But stocks are at all-time highs, and it's problematic because, I mean, on one hand, you have fears of the economy slowing down. Certain sectors of the economy seem to already be in a recession. On the other hand, it looks like the jobs numbers are coming in too hot for the Fed to be able to cut rates, but the unemployment rate is rising, inflation is falling. There's so many weird aspects of this economy and our markets right now that it's hard to say what's going to happen next. I can tell you definitively Nvidia will split coming today in after hours, and what will happen is Nvidia will start trading as the split company coming on Monday. And that's when maybe you could get a larger sell-off, and that could lead to some downward pressure in our markets. Nvidia has accounted for over half of the S&P 500's gain in 2024, so it's very important. You can also see at the time of recording this video, Nvidia is starting to give up even more, down about 1%. Other AI adjacent companies like Dell also selling off quite a bit, down about 4%, and that's also not doing the markets any favors. Heading into next week, we will have the Fed meeting, and I think that will be one of the next big catalysts for our markets. The same day as the Fed meeting, you also get the CPI report. Expectations are CPI is going to fall, so that could be good news and could offset some of this hot jobs report, but I think all of that is up in the air, and nobody really knows anything following today. And you did have this news that came out about 10 hours ago. Nvidia CEO Jensen Huang to sell up to $735 million in stock. And again, I think that could lead to a pretty rough start of next week for Nvidia shares. And it does say here, Fed swaps no longer fully price in a rate cut before December. But here you can see throughout the trading day, we are no longer expecting the first cut September 18th, 49.5% chance of a continued pause through September 18th, and a 46.6% chance of a cut coming September 18th. November 7th is when the first rate cut is officially priced into markets in a greater than 50% capacity. And well, unfortunately, that's probably not going to happen November 7th, right after the election. I would be surprised because that would be seen as pretty political. December 18th, you do have a 12.3% chance of a nothing from the Fed throughout the rest of this year. 39.6% chance of the first cut December 18th, and a 36.5% chance of a continued pause through December 18th. So either November or December is what the markets are saying for the first cut. Now, I want to remind everyone out there, I know you can get lost in the sauce and this data and that data and this data and that data on a week-by-week basis. Remember this, the only thing that truly matters is inflation. We can add 270,000 jobs to the economy for years. It doesn't matter as long as inflation comes down. If inflation comes down, then the Fed can cut rates and you have your perfect soft landing because, the economy looks like it's adding a lot of jobs. So I think coming next week, when you get the CPI report and the Fed meeting, that's actually going to be the big catalyst for our markets. What happens between now and then? Let's be honest, it's probably going to be correlated to what happens with Nvidia. And after a split, you do tend to get a sell-off, and that's kind of how I would think about the next couple of trading days. CNN's fear and greed indicator is neutral at 45. 1 week ago, it was neutral at 48, and 1 month ago, it was fearful at 37. So you're definitely starting to fall again, almost back into a fear territory for CNN's fear and greed index. The percent of stocks above their 50-day moving average today is 44%. So about 3% of all stocks today are falling under their 50-day moving average. That's a pretty rough day. Comparing this to even mid-May, when you had over 63% of stocks above their 50-day moving average, you've fallen quite a bit if you're just an average stock. Your latest AI investor sentiment survey is at 39% bull, 29% neutral, and 32% bear. That means you are at the highest level of bears. This was as of June 5th. As you have been in a couple of months now. And this is more bearish than historical averages of about 31%. Now, again, like I said, 10-year treasury yields are up almost 15 basis points. That's roughly the equivalent of half of a rate hike from the Fed. So it's really not a big surprise that stocks are selling off today. And, especially heading into next week, even if you look at the RSI on the NASDAQ, the triple Qs, the NASDAQ 100, it's at 67. You're pretty close to being overbought. And heading into your major catalyst with CPI and the Fed, it wouldn't surprise me if you do get a little bit of a pullback here, especially considering this rise today in 10-year treasury yields. So with that said, let me know what you think about all of this information down below in the comments section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.